from the regulators and the bankers. But I think that is the after stage. After this pandemic is probably controlled at some stage. So till that point of time, I think the volatility that you're probably witnessing is something that is controlling global markets. And the third part of the webinar is where we will discuss the current market scenario and the way ahead as per the ODL methodology and what Canslim has to offer on how to read the market direction and how do you time the market. So with this, I will take you through the 3 stages of the presentation. So I'll be opening the presentation right now and taking you stage by stage in terms of how are we going to approach the current scenario and the way ahead as well. Yeah. So the picture says it all, right? The bear is viciously looking at the bull. The bull is receding its ground. The bull is treading backwards. On the left hand side, you've got crude, and we could not put that onto the slide at this point of time. But the bear is probably dominating the bull, and the bull is wearing a mask. So I think the 3 C's, as we've time and again mentioned in our earlier reports as well, the coronavirus epidemic, COVID-19 as it is known, the slippage in crude prices, and the credit risk aversion that the system has seen, specifically in the Indian context and the aftermath of the Yes Bank crisis and the fiasco thereof, is creating a huge dent, and that is clearly what is rattling the street. So I think the 3 C's have been extremely dominant over the last few weeks, not just on the Indian markets, but the global markets as well. Now, our founder, William O'Neill, has beautifully coined the quote, which we've rightly put through into the slide as well. And this is very, very important for market participants to note. I think we all love bull markets. We all love markets going in a unilateral direction that is upwards and northwards. But markets are ultimately a slave of both cycles. So you are going to get your up cycles, you are going to get your down cycles. So bull markets, bear markets are a part and necessity in terms of how the financial markets move and function. So what he quoted was, and I'll repeat, bear markets are normal and necessary and serve to clean up prior excesses. They also allow the market to create a whole new set of chart bases and leaders for the bull market in time, which always follows. So I think this is a very, very important understanding that one must have, that they're absolutely normal. They also clean up the excesses, because what you had seen in the system was that with easy printing of money over the last few years, asset inflation, specifically in terms of share prices, stock prices, had moved up in one direction. But again, I think with bear markets, I think those excesses are cleaned up. Valuations probably become far more normalized. And again, I think there are a new whole set of leaders that probably come through. So every cycle that you would have probably seen, and which I'll explain in detail in part 2, every cycle has a new set of leaders. That is what William O'Neill is pointing out, and that is how it is precisely played out over the past 2-3 decades. All the earlier crises as well has thrown up new sectors, new stocks within those sectors, And that is a very important point to observe and note. So a standard disclaimer that we run, that whatever stocks we might discuss in the course of this seminar are just for educational purposes, and it should not be in any way considered as an investment advice. So I think this is the agenda that we'll be running through. As I mentioned earlier, for those who follow Canslim, the market direction would be a well-known fact. For those who don't, I think I will quickly take you through what do we mean by market direction and how important it is in context of where we specifically are to understand and judge the different market cycles, to understand and note where we lie at this point of time, and when do we need to act as the market data throws up relevant signs, because that is the time that you'll probably be making the most out of your investments rather than just betting on to something which is a large unknown at this point of time. Part two, as I said, will be the corrections that we've seen in the past and what were our learnings out of that. Part three, the current COVID-19 crisis and the way we look ahead, both from a ONI lens as well as what our thought process is in the way to time the market at this point of time and the philosophy thereof. So Canslim, right? I mean, a lot of participants who are aware might be knowing that Canslim and each alphabet thereof stands for a particular word or particular meaning attached to that. And it's got a very, very relevant meaning attached to every alphabet that is attached. Canslim methodology has been coined by William O'Neill, and this methodology has been working absolutely fine for the past 50 years. So I think we've backtested this over a period of time. We've backtested this across simulation models. And what it does is it combines fundamentals, it combines technicals, and it also gives you a fair bit of an idea in terms of how the market direction is. So I think to put it very, very simply, I think, as I said, every alphabet has a meaning attached to that. C for Canslim stands for current earnings. Simple way of looking at it, the earnings that a particular stock derives, both on a quarterly basis and both on annualized basis as well. So the first two alphabets, C and A, is the current earnings scenario, which is how the earnings are panning out in the current context. The A part is the annualized earnings. Again, I think the earnings per stock that is aptly measured through our mechanism. The N part is a very, very important part for the Canslim methodology. And it also relates to a lot of new things, new products, new innovation, newness in something that the company is trying to achieve, which can create a new niche for the companies themselves within their marketplace compared to their competitive peers and their positioning in terms of coming forward as a market leader in the spaces that they operate out of. So the N factor is very, very important at this point of time. S is nothing but supply and demand. How much is the activity that the stock is witnessing, both in terms of buyer demand as well as the seller demand. And this also relates indirectly to how the stock price movement will pan out over a period of time. The L part represents the leader or the laggard position that the stock has. And we always believe, because we are great proponents of growth investing, that you should stick with leaders and not laggards, because laggards are companies which would probably taper off, and leaders are something that will continue over a length of time. So as I mentioned earlier in the first slide that I'd shown, market leaders are thrown up across different market cycles, and it becomes very, very important for us to recognize that every market cycle will produce different set of leaders. And if you are on top of things at that point of time, these leaders can generate returns far, far greater than the laggards that you probably hold on with the expectation that they will deliver at some point of time. The I element is the institution holding within Canslim itself. So how many institutions are holding the stock? Because a lot of institutions are actually drivers of how the stocks might move, both from a short and long-term perspective as well. They are solid investors who are invested into the company with a long-term time horizon. and they've done their due diligence in terms of analyzing the sectors and the stocks within those sectors before they enter and have major positions in the stocks covered. So institution holding becomes very, very important from both perspectives. If the institution holding is going up, there is obviously huge interest both in the sector and the stock covered by these institutions. If the institutions are probably offloading their stock, there is something that obviously draws a red flag, because if large institutions are probably leaving a stock, there is something which is amiss, which gets triggered off and which should be observed. So the I part of the institution holding becomes extremely critical in terms of monitoring. The M part is the market direction, and that is very, very important in what I was speaking earlier as well, which I would be taking through over the next few slides. So how the market direction plays out will have a huge impact in terms of the first six attributes: earnings, the newness in products, the supply demand, whether they'll be able to hold on to their leadership position, and the institution holding, both from a buying and selling perspective. So the market direction and where we are at a particular point of time is extremely critical. So we at Canslim actually have devised and put all these elements together very, very beautifully. If you look at MarketSmith India, AlgoSmith, our products, which derive a whole host of attributes, facts, figures from all these data points derived over a period of time, the current data points at play, and everything is displayed very, very beautifully, because the fundamentals are very well covered in the entire methodology. The technicals are brilliantly covered, because the chart itself is displayed to you on the product itself. So I think there is no homework that you probably need to do, but identify the trends that are thrown up through the software itself. And the software itself gives you identification points, both in terms of pivot levels that you need to watch out for when you're entering the stock. And at the same time, I think when you should be probably looking at exiting the stock with a very, very strict stop loss rule, which I'll be taking forward as well in a terse manner. So I think the combination of both fundamental factors, technical factors, which are displayed through the product itself, and a lot of information thrown through in terms of the evaluation matrices that each stock has got, the checklists that we carry in terms of the fundamental and the technical aspects, and again of the key details that are required, both from a fundamental perspective with balance sheet details, earnings details, P&L details, and the minutest observations in terms of chart formations, which are aptly displayed through the chart, through the charts and the evaluation tools that are available on the product itself. So again, I think this is how Canslim is devised, and this is how Canslim works in the entire ecosystem of the O'Neill methodology. Now, when I was talking about the importance of market conditions, I think these 4 points are extremely critical to be observed. So what we are saying in terms of market downturns, market recessions, I think you should be identifying the market moment very, very clearly. There is no point in challenging a market direction. So let's get that point very, very clear. So you've got different market scenarios, right? So when you're in a confirmed uptrend, when the market is going all guns blazing, yes, that time I think you'll get plenty of ideas moving around, and those ideas are something that can be worked out brilliantly at that point of time. Unfortunately, I think at the point at which we are at this point of time and the market cycle that we are in, we are clearly in a down market. We're clearly in a market where a lot of red flags related to recession in terms of economic and financial deleveraging is playing out. And that is how the market is at this point of time. So when you are in a downturn, right, the analogy that is aptly put out is you can be like trying to swim against the ocean tide. So if the ocean tide is coming towards you, you cannot swim against it, right? So you might make some progress, but a big wave of selling can actually drown you. So I think let's admit to the point that we are in a downturn, and you should be very, very careful in market conditions like this, where you probably are trying to time the market at this point of time and trying to find the bottom of the market, which probably remains a large unknown at this point of time. So you'll find a lot of people on the street telling you that invest 10%, 15% at this point of time. Our methodology probably states that you probably need to give it time. I think there is no point in challenging a market direction, in challenging the market timing at this point of time. Once you've got confirmed signals, and that is where our O'Neill methodology strongly believes, and the belief is very, very clear, and we are very, very strong proponents of believing that the market trend should actually show some stability, some strength before you start entering into the market. So I think let's get this point very, very clear. A 10% buying on dips, I think does not work in market conditions like this. It's extremely volatile, extremely choppy, and preserving capital at this point of time is extremely critical, rather than being very advantageous and being very, very bold, which can backfire from a short-term or a medium-term perspective. The second element, obviously, in a market condition is that markets, the majority of the stocks will follow the market direction, right? So I was saying earlier, in a market which is in a confirmed uptrend, where the markets are rallying, all guns blazing, you'll see most of the stocks flying around. At this point of time, the broader universe stocks fly around even faster, right? The stocks which are having a huge beta correlation start moving in abrupt price motions in northward directions going ahead. But that is when the market is rallying. If it's in a downturn, right, the stocks will get cracked down. And I'll show you the Nifty 50 chart, both from a week's perspective and a year's perspective, on how things have changed drastically over the past few weeks. I think they always tell you that trend is your friend, right? So a better strategy is to follow the market's trend, follow the market's general flow, and then you have to probably assume that the market will tell you the signs. So I think the signals is something that you should keep on monitoring, that the markets will keep on throwing at you at every point of time. So if you determine and have different sets of time points assigned, the market will be throwing you a lot of trends on that. So I think you're supposed to get into the markets when the markets are doing very, very well. But if it's a downturn, I think you should probably be sitting on the sidelines and then waiting for the markets to show you and give you those signals of price and volume stability before you start entering in. And the last and the most important point is that you should leave your biases aside. So I think you'll be hearing a lot of chatter in terms of getting into the market. This is a very good time. The correction has been pretty brutal, but let's admit, I think the corrections can be even further and deeper. Nobody knows about this. Everybody will agree to one simple point, that nobody knows where the bottom is. And equally true, I think, since you don't know where the bottom is, the market will also not give you a notification on the stock exchanges saying that we're going to start rallying from this day. So the markets, as I said earlier, and as I've been mentioning time and again, will give you the signals, but getting adventurous and getting into the markets, because the markets have fallen 36% till date, at least for this crisis, and assuming that the worst is probably over, we're very, very close to the bottom. See what the markets have done in the past 2 weeks. We hit the lower circuit, we recovered on that same day, we moved higher the next day, and what did you see? I think the markets have trended downwards again. What you're probably again seeing in overnight action, the Fed was down yesterday significantly. SGX Nifty is down significantly, as I've seen the futures trade before coming into this webinar, which makes the market scenario very, very difficult to judge, very, very difficult to time. And therefore, I think sitting on sidelines in market conditions like this is the apt strategy. Our strategy at William O'Neill is very, very clear. We intend to protect capital. We also intend to minimize your losses in case the bets that we probably go with are probably going against us for some reason or the other, but limiting your stop loss to the 8% rule, which is very, very important to follow from your buying point. When do you exactly enter a stock? The exact pivot levels to enter the stock are extremely critical as well. You cannot enter into stocks which have gone into an extended rally and then blame that if the stock comes down that we got hit or we got stopped. So I think all these characteristics are very, very important, but these need to be followed when the market direction is by our side. And at market conditions like these, I think it's always better to stay on the side. Now, these are the different market statuses, as I've been mentioning earlier. For all the market participants who follow Canslim, they must be familiar with most of the terms that we use. For the other market participants who are not familiar with the terms that we use, I think it's basic and it's very, very simple. We've got 4 methodologies or the 4 market conditions that work in different scenarios. So the obvious scenario that you see right on the top The rally scenario is where the markets are rallying, right? So what you saw for the better part of the last quarter of last year, after Nirmala Sitharaman introduced the corporate tax cuts, and the markets entered into a different zone, and they just kept on rallying, 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 and we hit an all-time high in the month of January, in the next 4 months itself. So that was the rally position in the markets, where we clearly put out that in this markets, you're going to get absolute number of ideas that come through, and you're going to get different ideas that come through. But again, I think the system and the methodology will throw out ideas which can outperform over a medium duration of time and outperform a lot of its peers in terms of both the methodologies that we follow, in terms of the fundamentals of the stock being solid, and the technical charts or the technicals of that stock being very, very solid as well compared to its peers. And what we do at William O'Neill and the Canslim methodology itself is do a lot of peer checks, their group rankings, how they are stacking up against the group, and it throws out stocks which probably can outperform others, not within the group, but within their basket as well. Obviously, I think the under pressure, the correction and the rally attempt needs to be understood in this context. So when the market is under pressure, there is a concept called distribution day. So we've got a total of 4 to 6 distribution days in 4 to 6 weeks. So say you're starting off as week 1 right now. Over the next 4 to 6 weeks, if you get 4 to 6 distribution days, you're clearly seeing that the market is coming under pressure. Now, one may ask, what is a distribution day, right? So the distribution day is nothing but when one of the stock indices, now if you're following the Nifty, for example, which a lot of people follow, so if Nifty falls more than 0.2%, if it falls more than 0.2% in a single day on a higher volume than the previous session, so if the Nifty falls on a Tuesday, which is more than 0.2%, and the volumes on Tuesday are higher than what you witnessed on Monday, that is what will be counted as one distribution day, right? So distribution day is very, very important because it helps us understand whether the markets are coming under pressure. If the number of distribution days keep on increasing, if they go beyond 4, 5, and towards 6 in a matter of 4 to 6 weeks, I think there is an issue with the market, and the market is coming under pressure. Slowly and steadily, I think the market is drifting downwards, and therefore, I think they are the first ominous signs that should be kept on your radar, that if so many distribution days start stacking up in a matter of a few weeks, there is something which the market is telling us. So as I said earlier, the market itself will throw a lot of data points. The market will throw a lot of price actions as us, and to identify that is what the methodology does. And if you're on top of things, you will be better off, I think, staying or starting to trim your position if such positions start happening. Now, if the uptrend is stalled in a few weeks, right? So if the distribution days are stalled, and we come back to the entire concept of this different market scenarios and market conditions itself. So if the distribution days are stalled within that time period, the market might be actually stalling at that point of time. But again, I think if the number of distribution days do go up, I think we do make the market a little bit more light. So what we say is from the rally attempt, if the distribution days increase to 4 to 6 days in 4 to 6 weeks, then the market is coming clearly under pressure. So if you got 3 to 4 distribution days in 3 to 4 weeks, the market comes under pressure. If the number of distribution days increase to 4 to 6 in 4 to 6 weeks, so again, I think the first 3 to 4 weeks, if you've got 3 to 4 distribution days, the markets will come under pressure. So you've got your first ominous signs that there is something wrong in the markets itself. If these distribution days increase and the count keeps on going up between 4 and 6 in a matter of 4 to 6 weeks, the market clearly is coming under pressure. So I think the market from under pressure then goes to a correction mode, which means that you've got positions into the markets. You're better off in trimming off those positions because I think the market is trying to tell you something which can go wrong within the market itself. Now again, I think the corrective mode of the market can very well continue for a period of time, and that is what is precisely happening at this point of time. So what you're seeing in the current market scenario and what you're seeing in the brutal sell-off over the past few weeks, the number of distribution days had increased substantially. So ever since the virus threat started coming off from the end of Jan, the first week of February, the number of cases for corona going on, keeping up in the Chinese market itself, the market had started throwing indications itself by the second week of February, and the number of distribution days had slowly and steadily started inching up. So we had started to get that feeling when 3 or 4 distribution days had bunched up in the next 3 to 4 weeks, where we downgraded to the market to under pressure. And those number of days started increasing substantially over the next few couple of weeks as we went ahead. So the market was clearly getting into a corrective mode. And that is what precisely what happened over the next few weeks. So the brutal sell-off that you probably saw was more of an indication of what was coming in the prior 4 to 6 weeks. Now the corrective mode that the market is at this point of time, where the Nifty is keeping on undercutting its lows, and there is no stability that we're probably seeing over a period of time. So how we judge how to get out of the correction mode and when will the market actually come back into a rally attempt? So for that, you probably need to give 3 days. So you need to give 3 days where the market does not breach the correction low, and where these 3 days show positive traction both in terms of price and volume action. So if the breach of correction low has not happened on a closing basis, and if the markets try and attempt to stay and stabilize on consecutive 3 days over the correction low that we probably seen, we can fairly assume that the market is trying to attempt a rally. So what you've been seeing from a correction mode that the market is to a rally attempt, you need to have these 3 days in place with a lot of positive price and volume action. Now here again, I think the rally attempt is nothing but a limbo stage. Yeah? So what you probably need to understand here that there has to be a follow-through day, which the market needs to attempt post the rally attempt. So you might very well get a few days like you witnessed yesterday, right? That the markets rallied significantly. The VIX came off. So the VIX, which had shot up to 72, suddenly came down to 67 odd. And there again, I think you saw the market actually giving a huge move. But how sustainable is this move is the next 2 days what will tell us, both from a price and a volume action perspective as well. But clearly, I think the whole bottom line here is that within these 3 days, if the Nifty correction low is not breached, you probably got a rally attempt. If the Nifty correction low is breached, then the rally attempt has failed and you're back into correction mode. And you'll probably wait out very clearly as the methodology shows up for the next 3 days to come up and the next rally attempt to probably come up, which will probably give us some indication whether the market is trying to find its feet. Now, how do you probably get from a rally attempt to a rally attempt again? I think you need to wait out for a follow-through day. And this is very, very clear. So again, the rally attempt is a limbo stage is what we are saying. There is no need to be concerned with distribution days at this point of time, but you're more bothered in terms of how the market movement might take place. So again, I think the market data points and how the market throws information as us is very, very critical in judging where we are and whether we should enter into the market again. So again, entering into the markets during rally attempt days does not make sense because it might very well fizzle out, as I said. If the market corrects and breaches its correction low during these few days of attempt that the market is trying to find its feet, the rally attempt has failed, which means again that the undercut of the Nifty continues and you might find yourself from an index perspective looking at lower levels again. So the rally attempt to the rally attempt needs a follow-through day, and what is a follow-through day is extremely critical as well. So how do you spot a follow-through day in terms of the elements that are required and spotting for the follow-through day itself? So I think the simple logic that we follow at William O'Neill is what are the key elements of a follow-through day? So again, I think looking and taking an example of Nifty as the major index, if the index or say Nifty closes up 1.5 to 2% or more on volume, which is more than the prior day, that is what a follow-through day is. So as simple as that, you've got 3 days of positive traction where the Nifty has not undercut its correction low, the earlier correction low. We've clearly entered into a rally attempt. From the rally attempt itself, uh, the follow-through day can happen at any point of time. So the fourth day or later in a rally attempt is normally and typically when a follow-through day happens. The volumes, as I said, is nothing. It should not be more than above average. It has just to be more than the previous day. So again, I think if you've got 3 days of a market move where we've shifted the market, where the markets have shown good traction, it has not undercut its previous low, you've entered into a rally attempt. The day 4 or any other day after that, if Nifty closes up more than 1.5 to 2% on volumes higher than the previous day, you got a follow through day. Now, how do you spot a follow through day, right? So now in the correction mode that we are, and typically in a correction when the market makes a new low, you typically need to look out for the first day that closes up from the prior day. So normally it's day 1 of the rally attempt. So as long as the index stays above its prior low, attempted rally remains in place. So let's put this through an example in terms of understanding of this market condition. So as I said earlier, right? So you're placed at a particular point of time, and the left-hand side of the graph is clearly pointing out the day 1 of the rally attempt is, for example, when the market hits a new low and it closes higher for that day. So that is counted as day 1 as per the Olean methodology in terms of counting the number of days for the rally attempt. The next day, the day 2, is the day when the index rises on good volume, but it's too early to say it's follow through day. So even if the index rises, say 1.5%, 1%, I think it's too early to call it a follow through day because we need to have 3 days in place before we first change the status through to as a rally attempt. The day 3, the market probably declines, right? So it's not that all 3 days the market will show positive traction. Say the market declines on the 3rd day, but it doesn't undercut its low that it has made on day 1. So I think if that condition remains constant, the rally attempt remains intact, and there is a chance that the markets might stabilize going forward as well. Now, since the 3 days are in positive traction and you've got a rally attempt in place from day 4 till day 25, right? We'll be patient enough because you need to have a follow through day that comes through. You've seen what a follow through day is. So if that follow through day comes through any time between day 4 and day 25 in the days to ensure, I think that will be a clear signal for us to enter the markets. And there we can definitely say that there was a bottom in place going back as we've seen in the past as well. So I think you need to understand all these market scenarios very, very clearly. The rally attempt is the easiest. There is no two ways of understanding how a rally attempt plays through. Under pressure, 3 to 4 distribution days. You've seen what a distribution day is. It's 0.2% that the market corrects. If it's 3 to 4 distribution days, 3 to 4 weeks, the market is coming under pressure. If the number of distribution days keep on stacking up, if there are 4 to 6 distribution days in a matter of 4 to 6 weeks, the market is coming under pressure. The market is giving you signals that you should be lightening your position, lightening up in the market at that point of time, getting off stocks, booking your profits, staying on cash, and staying on sidelines. The correction mode, as we currently are going through at this point of time, clearly staying on sidelines, conserving your cash becomes very, very critical, very, very important. When do you start entering the market? We've clearly seen how different scenarios play out. So you should wait out till that rally attempt plays out. Once the market status at the 3 days gives you that rally attempt and it is followed by a follow through day, I think that is when you should enter into the market because the rally attempt can be quite feeble. It might give you false signals. It might also give you an option that you should probably be shortlisting once the rally attempt comes through stocks which have shown solid price patterns, which have solid earnings pedigree, and probably look out for the follow through day in terms of all these indications coming through before entering the market. So I think this is how we place ourselves in the current market scenario. We are clearly in a correction zone. Stay on the sidelines, wait for the rally attempt to come through, and then we'll wait out for a follow through day before we start building in positions for the market itself. Now, this is the current market scenario. Uh, so here clearly again, I think what we are trying to point through, if you see on the left-hand corner of the chart itself, the first table or the first tabular text that has been put through, this is the announcement that Nirmala Sitharaman did on September 20th when she slashed corporate tax rates. So once the corporate tax rates were slashed, you see what happened through the market. So the market was absolutely moving sideways before that, if you would have observed. But after that, when you probably saw the market and the market in terms of the Nifty index itself gave a move of 2% or more. In fact, that was a larger move, more than 2%, with higher volumes on the previous day. So we got the follow-through day that we normally require to be seen in the market itself, and that follow-through day was clearly seen on September 20th. You after that saw how the markets moved higher and higher and higher. Now the markets touched its all-time highs. Again, I think the Nifty made a high on Jan 20th of 12,420. But again, I think you see what happened after that. I think the chart might not be a little bit clear, but largely, again, I think the market trend started coming under pressure. So I think the number of distribution days, as we discussed, started inching higher. So I think there were more than 3 to 4 distribution days that we witnessed in 3 to 4 weeks. And the news of the coronavirus epidemic had started coming off from China. So clearly, I think we started downgrading the market to under pressure from the rally attempt or the rally that the market was witnessing. But the number of distributed days kept on inching higher. If you see the line, the key indices, the 50 DMA, the 200 DMA that was clearly getting displayed, the number of distribution days started inching higher and higher and higher. And it moved higher in excess of 5 to 6 over a period of 5 to 6 weeks. So clearly downgraded the market. And that was also a clear breach that the market started breaching its key support levels in terms of technical indicators from the 50 and the 200 DMA as well. So the market was downgraded into a downtrend, and see what has happened to the market after that. So I think the market, as I said, gives us signals. We need to be cognizant of the signals that the market is throwing up. I think this is a very simple and a very effective strategy that can be deployed. It is not rocket science. I think if you just observe all these few days that probably are going through, how the market direction is changing, how we change our status and market direction and trends through our product, through our software itself. I think those indications are very, very clear. And that is how the market direction actually throws up on signs and eminent signs that the market might go through. Now, clearly at this point of time, as I said, we are in a correction mode. We are clearly in a downtrend at this point. There is no point in challenging the market direction. We need to identify and establish the 3 days that I talked about for the rally attempt. We need to establish and look for a follow through day. Once we get that imminent signs in place, we will then enter the market. Till that point of time, I'm repeating at the point of repeating myself. We will monitor the market and the market data that gets thrown at us and monitor these attributes very, very clearly. Because once these attributes are followed and once those directions and data points are thrown at us, the market trends, if you follow that, and again, I think if you follow the Canslim methodology in following the fundamentals and the technicals and the stocks that the system will throw at us, I think the kind of money and the kind of returns that can be made can be substantial rather than punting at this market where I think every dip probably looks like a possible buy but never plays out to its full potential as it is. So I think this is the current market scenario. This is how we should probably be looking at playing the market trend, and this is how we should be identifying how the market is positioned at this point of time, both in terms of market direction as well as our positioning in terms of deploying capital. This is the Nifty performance. This has been taken till Thursday. So I think yesterday's move has not been captured. There might be a minor difference in returns given yesterday. But largely, again, I think if you probably look at how the entire Nifty movement has happened, it has largely been all reds, right? So pick up any stock that you have on the Nifty index itself. Very few winners have been marked in the green. So few of the consumption-led stocks are in the green. So Asian Paints, to a certain extent, Hindustan Unilever, Nestle, and surprisingly, I think a few of the PSUs are in the green as well, and a few healthcare. But largely, I think the markets and how they have stacked up with the brutal sell-off that we had seen are very, very eminent. So if you would have followed the market direction, and when we downgraded the market, we clearly had downgraded and trimmed all our positions from the suggested portfolios that we had, and we had come off, and we were waiting on the sidelines, and we are still waiting on the sidelines. Once the market throws out new signs and new stocks, whether it's from the Nifty index or the broader universe, where earnings are stable, where the chart bases have been properly formed, and where I think the technical and the fundamental indicators are pointing to both the EPS rating, the RSI strength, actually holding up for the stock from a Canslim methodology, that is the time we'll enter. We are absolutely on the sidelines at the behest of repeating myself at this point of time, unless we get the rally attempt and the follow through day as discussed earlier. That concludes part one. We'll start off with part two in just a minute. Part two is basically what I want to take you through with the major corrections that have happened in the past from an Indian context. So with an Indian equity market in perspective, the prior market corrections in 2004, 2008, which also had a global implication because that is where the global crisis flared up, 2011 and 2015. And then what were the key takeaways from all these major corrections at play is something we'll take through. So in a minute, I think we'll start off with all the past corrections. Yeah. So these market corrections have happened in the past. So I've taken out market corrections from 2004. I'm not taking, and the prior corrections which have happened were all happening for a different reason. So we all know why the 2008 crash happened. But if you can see the table on the left, so the first column is clearly when 2004 crisis took place, and Nifty, before the crisis took place, the Nifty hit a bottom. And obviously, I think there was great expectations from the NDA government at that point of time, and Atal Vajpayee coming back into power. And that did not happen, surprisingly, which the markets were stunned. And the market reaction was for the taking at that point of time. The market hit a bottom. Now, this is all being discussed because this is in hindsight, and this is how historically we have come to comprehend that the market bottom was made at that particular point of time. So, May 17th, 2004 is when the Nifty made a bottom. It actually corrected 36% from the all-time high to the bottom, and it took almost 129 odd days for the Nifty to make that bottom. So the initial knee-jerk reaction after the results came in, and the slow and steady grind that Nifty had towards its bottom, I think, was it played out over 129 days. Now the global crisis, which played out in 2008, and the all-time high that the Nifty touched on Jan 8, 2008, and the lows that it hit. So the absolute bottom, again in terms of hindsight and data that we've got, was hit in 2008 October 24, and the Nifty had corrected a whopping 65%. But it had taken a good 290 days for the Nifty to correct over that time period. So yeah, I think at that point of time as well, I think market participants who remember the Nifty or the indexes also had hit circuits. Everybody on the screen was stunned. I myself remember looking at the screen and then circuit and a back circuit after that, and the market was closed, and that's it. So I think the the global financial crisis was something that shortly our financial ecosystem, uh, and again, a long period of time for the market to hit the bottom, because I think the understanding in terms of what needs to be done during the global financial crisis is a lesson that was learned in a very, very hard way. So a lot of financial institutions on a global scale went bust. A lot of the leading investment banks in the US went bust. The financial contagion was seen not just across stocks, across currencies. The bond yields had spiked up. So I think there was chaos within the financial ecosystem itself. But it took a long, long time for the markets to probably find its feet. And 290 days is exactly the number of days that the markets took to find its bottom. Uh, Again, 2010-11, a different crisis within itself. Uh, some elements global, which also played out locally for us. But again, the market from its all-time high to finding its bottom took a huge amount of time. So I think it almost took 400 odd days, almost a year, for the market to find its bottom in that period of time. So the markets were doing nothing. It corrected 29%, but it was a slow and a steady grind downwards. A few sectors and stocks did outperform during that time horizons as well. Therefore, it's very, very critical to understand, as I put forth in the first slide that we had displayed, bear market, they are bad in nature, right? Because ultimately the bear market will lead. It gives us time to ponder. It gives us time to analyze what had gone wrong. The excesses that were built in the system clearly get off. A lot of risk gets off the table. But a new set of leaders are born. New stocks, new sectors take leadership position in the bull markets to follow. And these stocks and sectors are something that needs to be identified. And once you are able to do that, I think you are having leaders on your hand that can lead the charge in terms of making a very, very good return on investment, rather than punting, as I said, into the market at different time points, assuming that the worst is over. 2015 again had different set of challenges on its own. The correction again was quite okay. So I think if you compare a 2008 correction and the current correction, I think the kind of days that the market spent compared to 2004, I think 2010 and 15 is when the market spent the maximum number of days in finding its bottom, and also corrected the least in terms of market corrections on a historical scale. So again, I think it took almost 362 days for the 15-16 correction to finally find its bottom. But from there again, I think the market movement was substantial till what you saw at this point of time. Now, the current market correction has been quite brutal. So it's been just 40 to 43 odd days, and you're already 37% off from the top on the all-time high of 12,400 that you probably made. So again, whether you are finding a market bottom at this point of time, again, the methodology itself and the market data will throw that to us. So again, there is no fixed methodology which will help you find the market bottom. It's always in hindsight that market bottoms are discussed. But looking at the methodology that we discussed in part one, you've got a fair chance. So you've got a fair probability in presuming and assuming that the methodology actually works. And we've actually time tested this over a period of time. That if you follow this, I think you've got a fair chance to at least enter stocks and to enter the markets with the presumption that the worst might be probably behind us. So again, in the current context, those tables are bottom and the Nifty bottom absolute level. But the rally attempt days, the follow through days, if that do come through, I think you will have a fair chance of determining that the Nifty low, or the low which was made prior to the rally attempts, might be the bottom that one was looking over the next few days and weeks. When that will throw up, I think is a matter of time. So one needs to be patient. One needs to be on the sidelines. Keep your gunpowder or your cash dry, as they say. And once those signs come through, we go all in terms of so the reversal rise and the kind of returns got generated. So again, if you probably look at the entire index move and how each sectors played out. So 2004, the Nifty fell, as I said, right? It was almost a 42% move downwards during that point of time, where you probably saw which were the major indices or the subsectors that declined the most at that point of time. So Nifty Bank, Nifty Finance, which probably incorporates a lot of NBFCs, apart from banks. So I think the NBFC universe is largely covered in the Nifty Finance Index, and the FMCG were the major decliners during the 2004 crisis. Nifty FMCG and Nifty Finance declined the most. So I think the decline there was 34 and 27% respectively. Now again, I think once the bottom was formed and once the Nifty scaled a new high over the next few years, the indices that emerged were Nifty Finance. So Nifty Finance, again, which was declining 27%, emerged as the new sector leader. Nifty Bank followed suit, and Nifty FMCG was the most, the index which declined the most, right? Was the third index which probably gave the maximum amount of returns. So you put that in a tabular format, and look how these sectors have performed. So Nifty Finance, for example, I think had a huge move. So I think HDFC emerged as the best stock within the finance stocks during the 2004 crisis. I think the decline and the rally. Look at the rally that HDFC actually gave out. Cholamandal Finance was more or less relatively an underperformer compared to an HDFC. So HDFC probably has emerged as the new market leader during the 2004 crisis. Now, Nifty IT had a relatively subdued move at that point of time. A lot of stocks during the 2004 crisis, right, were not listed, which are currently there. But Nifty IT had a sideways move. Within Nifty IT, Wipro declined almost 29%. But again, I think during the rally, after the bottom was formed, it emerged as a new leader within the IT sector, performing better than Infosys over the 2004 to the bull market and the fabulous bull market that we saw that ensued over the next 3 to 4 years, with the intermittent falls that it saw in the interim between these humongous bull rally that we had seen. But Wipro clearly outperformed Infosys. As I said, Nifty Bank, right? Nifty Bank also performed exceedingly well during that time period. The declines were most during the falls that we saw for HDFC Bank and State Bank of India. But both these banks, I think, performed very, very well. But HDFC Bank turned out to be one of the market leaders. So I think ICICI Bank and HDFC Bank emerged as the new market leaders within the Nifty Bank itself. FMCG, again, FMCG was a sector which declined the most during the 2004 crisis. HUL took the beating of its during this crisis of almost 43% odd. But the new leaders emerged. So I think every sector, as I said earlier, I think even if it performs going forward in a market rally, and every sector will perform, but every sector will throw out new leaders. It's not necessary that earlier market leaders will continue holding on to their leadership position. There will be new leaders within the sector itself that can take new leadership position in the rallies that follow. So when the Nifty made the previous high, HUL was clearly a market leader. From the 2004 to the 2008 rally, HUL did not perform during the rally as much as ITC and Colgate did. And ITC and Colgate had a gain of more than 300 odd percent during the market rally within the FMCG universe itself. Pharma, I think it's self-explanatory. I think I put in a lot of points over that same period of time. So Cipla declined, but the stock also advanced significantly in that time period. But Sun Pharma within the space itself emerged as a new leader. It did not correct as much as Cipla did even during the crisis period. And look at the outperformance. I think it gained almost 234% from the bottom till the next stop that the market gave. And it outperformed more than what Cipla delivered during that time frame. Nifty Auto, again, TVS and Tata Motors were the major decliners at that point of time. That a huge decline, specifically TVS Motor But after the crisis emerged, and when new leaders start emerging, M&M emerged as a new leader within the auto pack itself, and it gave a huge gain compared to the others during that time frame. So I think the whole intention of taking you through this crisis periods is how different sectors performed, and just to put forth our point that different sectors can take over leadership position. It's not necessary that a leadership position or a sector that carried leadership position during an earlier bull market continues to maintain that leadership position. There are new sectors which can outperform in that leadership position, and those signs will be thrown up by the markets itself. Those signs, as I'm time and again pointing out, will be thrown up through price and volume action that the stocks will display. Those stocks, those price points and data points will be thrown up through the sector rotation graphs that our product have. So the sectors which are getting into the most productive element, the quadrant one, as we call it, as the outperforming quadrant within our product, I think that gives us a clear indication of the next 26 weeks and stocks and sectors which are expected to do well. So the sectors which are expected to do well are known because I think their price patterns are getting identified through our sector rotation graph. The stocks themselves will throw out data points through our product and the Canslim methodology that we follow on which can get identified. And those again are data points that one needs to closely monitor. And that's the entire purpose, that the software, the products will throw out stocks, shortlist those securities, and we need to shortlist those securities specifically in the rally attempt phase that we've got. And during the follow through day, as it ensures, I think you will get out all these elements in place and the leaders will get identified and the stock positions can then be taken through in the leaders that do get identified. So the 2004 crisis threw out different stocks and different sectors which emerged as leaders. Now we come to the 2008 crisis and the different elements thereof. Now, Nifty 65%, as I said. If you absolute were the major laggards during that time period, what happened in terms of the rally attempt, right, and the follow through day and the new leaders which emerged after the bottom was formed. Once that started reversing, right, Nifty Auto actually emerged as a new leader during the rally. So I think Nifty Bank, Finance and Auto, which were the major laggards, Auto actually started off as and emerged as the new market leader in the 2008 rally. Auto index actually rallied almost 300 odd percent, so 292 odd percent to be precise, and it was actually followed by IT and finance. So I think the Nifty Finance and Bank, which probably remained laggards, still remained laggards post to 2008 crisis. The new sectors which emerged as leaders were Nifty Auto, Nifty IT, and Nifty Finance subsequently. So as I said, I think Nifty Auto, Finance and IT were the market leaders. Within IT itself, I think it's very, very self-explanatory on the graphs that I've put through. Infosys was something which declined. Tech Mahindra was something that declined the most, right? But it also was one of the most laggards in terms of price action. So yes, it did give returns in terms of price moment. But what TCS performed was nothing in comparison to what the others did. So TCS emerged as the new IT leader and gave a whopping 300%, 300% within the large cap space. And Wipro continued to be the other driver, which continued its good show post the 2004 crisis. Unfortunately, I think things have gone a little bit wary for the stock over the past few years, both in terms of fundamentals, and it has actually gone off the radar, both in terms of an investor interest and also in terms of the price volume action that is suggesting. But during these crisis periods, TCS was the leader, followed by Wipro, which kept on gaining, and it gained more than 200 odd percent. When we arrive at the NBFC universe or the finance sector that we see, Chola and Bajaj were hit the most during the crisis. But when you probably saw what happened after that, I think Bajaj Finance emerged as a new leader. And it did not stop after that. So I think you saw the stock going from 3 to 4 to 5 digits over a period of time, and fabulous returns that it has given over different time horizons. But during this crisis moments, Bajaj Finance emerged as the new market leader, and it surged more than 1,000% during the market rally itself. Chola Finance emerged as another key driver, and both these stocks apparently perform better. So I think the entire concept that HDFC, pedigree brand, huge kind of market share, but it was clearly an underperform at that point of time because market leadership position was taken over during that time period by a stock like Bajaj Finance, which delivered more than 1,000-odd%. Nifty Bank, the third best, as we discussed during the rally attempt from 2008 to November 2010. IndusInd Bank, surprisingly, emerged as the new market leader, and Kotak Bank. So I think Kotak Bank also declined as the second most declined during the fall in terms of finding out the bottom. But IndusInd Bank gave a whopping 600-odd%. ICICI Bank continued. So I think the continuation in terms of strong performance continued for ICICI Bank, and it continued delivering around 300-odd% in terms of market returns. The FMCG universe obviously had a high resilience during that time period. But again, Marico and Nestle were the new market leaders over the 2.5 year period of the bull market that ensued after the correction in 2008 that we witnessed. Pharma again had a relatively reasonable show, but Dr. Reddy's emerged as the new leader within the pharma space. Aurobindo corrected 70-odd%, but it also had a huge rally after the bottom that it saw. So I think it's necessary to note how these stocks will perform. A lot of leaders will maintain their leadership position in ensuing bull markets, but it is also equally pertinent to understand that a new set of leaders might also take positions both from a sector perspective as well as the index perspective in terms of returning and delivering the rally that we probably see, both from a stock return perspective and also in terms of how of the firms with the auto universe itself. Motors were the major decliners, but Eicher Motors, I think, relatively unknown player, which was a very, very small player at that point of time. But again, I think it emerged as a market leader and it took on the biggies or the heavyweights within the industries itself. Two-wheeler player challenging Harvey in that sense. So in that sense, again, I think Eicher Motors emerged as a new market leader with a 70% market. So that was largely 2008. I think it was more a known fact at that point of time. The global contagion risk from a financial deleveraging perspective was clearly playing out. Unknown at this point of time because I think it's both looking at the current crisis in terms of financial and economic deleveraging playing out, which is the large risk that equity markets are facing. But 2008-9 and the crisis thereof had a huge amount of underperformance. Once the bottom was, few leaders in place as well. So the 10-11 crisis, FMCG did not decline. In fact, it gave support to the market. Nifty Bank and financial services is something that declined the maximum for the markets. Once the markets reversed, pharma was something that led the index, followed by autos and the banks. So the FMCG universe, as I said, advanced 6% during the market fund. I think the correction also was not very, very substantial. But once the market bottom was formed and once we hit a new top over the next 3.5 years, new leaders emerged. So Hindustan Unilever obviously was there, but Britannia emerged as the best stock within the FMCG universe. The Nifty Bank and IndusInd Bank surprisingly kept on carrying out its good show. So again, I think the stock post its listing, the kind of performance it has, it took on the heavyweights, and the performance was carried out effectively with Kotak Bank and HDFC Bank, which carried on its very, very consistent show. The consistent show that was expected from HDFC Bank got carried out very, very effectively during that time period. Nifty Auto, again, I think stupendous show post the bottom. And again, I think Eicher Motors. So I think the strong show that it carried on kept on carrying forward, I think, market share gains because new products, I think the N factor that I spoke about in Canslim was very much on display here for Eicher Motors. It was a very, very new concept because earlier, I think the entire concept was mopeds, 100, 125cc bikes. But then you had a challenger coming through with a new product, a 650cc heavy engine, a stable bike, a bike which was very, very macho, which was projected at that point of time. So the newness of products, the new innovations, the new market share that it had, the N factor, which was very, very critical and it still is in terms of identification of a lot of stocks, worked out brilliantly for Eicher Motors over time. Bajaj Auto or even Hero MotoCorp. Pharma index continued its good show. Again, I think Aurobindo fell the most, but again, I think the rebound was equally strong. Divi's Lab provided support. So Aurobindo Pharma, again, look at the returns that the stock has delivered. So even if it fell substantially during times of forming the bottom, the outperformance that you probably saw in terms of the market rebound was substantial for a stock like Aurobindo Pharma, and Sun Pharma followed suit along with Cipla and Divi's Lab. Nifty IT again declined. Obviously, I think the decline will have its fair share of element. But during the bottom formation, Tech Mahindra, which fell the most, also rebounded the most. So again, I think the point we're trying to make here is that if stocks are falling like 9 pins during a correction, I think to monitor its price movement, to monitor different attributes within the Canslim element on how earnings are, how institution holding is, how its leadership position is, the newness that the stock or the sector is getting into play. It also performed equally well after forming the bottom. So Tech Mahindra and TCS emerged as the new market leaders. You arrive at the financial services of Nifty Finance, as we call it, which encompasses the larger, broader universe or the NBFC universe at play. It declined very, very strongly again during that time period. But again, Bajaj Finance and Chola continued their outperformance because they had a lot of newness, a lot of innovation that they brought out on the table, a lot of new products, a lot of innovation in terms of approaching and marketing these products, which got them a huge database. They were gaining a lot of market share. That things stack up, the revenue stack at a very, very fast clip and growing at more than 25% on how we see, and both the return ratios were equally stable. And the benchmark 17.5% ROEs were clearly getting surpassed, which is one of the key attributes that we have in terms of monitoring and shortlisting a lot of the finance-related stocks of the larger universe as well. Now, the 15-16 crisis had its own set of challenges. So the Nifty Bank and Nifty Financial Services, or Nifty Finance, declined the most. But once the market found its bottom, right, they also reversed the most. So surprisingly, I think the sectors which had corrected the most during the bottom formation and that crisis period were the sectors that reversed the most. And that was aptly followed by FMCG, because consumption, both in terms of FMCG and staples, grew at a huge pace in terms of the strengths and the strides that we are making in terms of economic progress, and also the purchasing power parity that we had in the discretionary spending and the discretionary incomes that were moving up. So Nifty Bank, Nifty Financial Services moved up significantly. I'll go to the right-hand chart first. So as I said, Nifty Bank declined the most during the corrected period, but it also rebounded very, very strongly with gains of more than 129%. HDFC Bank, again, the stableness in terms of the market position within retail helped them. ICICI Bank, again, the new innovations, a lot of their subsidiaries at play, which encompass the whole financial ecosystem, whether through its insurance arm, the asset management arm, the securities arm, clearly added flavor to the stock. So I think both these stocks performed exceedingly well during the 15-16 crisis. The Nifty Auto declined sharply, but again, I think it rebounded equally well. So I think the performance was seesaw, if I would put it at best. But Maruti turned out to be a new market leadership position, very well known for this company, across products, across product ranges, across price points, the number of dealers that it has got, the newness in terms of product designs, All this worked in favor of Maruti because I think the people, or generally, I think people want innovations, and that is what the company provided them. So I think Maruti clearly continued to be a leader during this crisis period, right up till the top that the market formed during the current scenario. Nifty Finance reversed very, very strongly. But again, Bajaj Finance had a non-stop run. So if you would have seen during the last few crises within the finance element itself, Bajaj Finance just was not petering off. The run was continuing, and look at the amount of gains it kept on giving investors. Valuations was something that was argued upon, but largely, again, I think if one just focuses on price earnings, which we believe is not the right attribute to be followed, I think it's more the growth attributes that need to be followed. So I think if you look at all the three elements of price, the earnings element, and the growth that the company is giving, I think all these three attributes need to be closely followed. The charts will tell you everything that need to be done. The fundamentals will tell you that the company's earnings are moving at a fast clip, whether they are able to sustain their base. And the company was able to sustain their base over a period of time, I think clearly got reflected in price volume action, in terms of their EPS rankings moving higher, and in terms of their RSI rating remaining top notch and in the top quartile, which gave the outperformance the stock did deliver. FMCG declined. Again, I think it's one of those defensive sectors that typically play out during crisis periods. So FMCG and IT is where a lot of investors flock to in terms of defensives. But so largely, again, I think the decline was there. But even during the fall, I think Nestle, which declined the most, also gained the most, along with Britannia, which also continued its humongous move. So I think most of the market leader and most of the FMCG have niche spaces created for themselves. The products that they probably offer are market leaders within their own spaces, and therefore the market leadership position and all the products and offerings that they've got continue to be top notch. Nifty IT, again, as I said, IT and FMCG probably are something that are considered to be defensive sectors. The reversed, so the Tech Mahindra TCS reversal was the most. But again, I think in terms of bottom formation, TCS and Tech Mahindra appear to be leaders. So yeah, TCS declined 21%, but it also gained almost 100 odd percent during the rally that followed. Pharma, again, considered to be one of the defensives during crisis periods. But largely, again, I think look at the move. So I think you've got a different leader, Divi's Lab with its API applications, the newness in terms of product launches, in terms of catering to a lot of innovators, having their business well mapped out. I think the newness in terms of their approach towards the pharma market is something that liked investors, and the earnings were very, very clearly indicative of that. So just the N factor working more than without numbers is not of any help. The N factor which works along with numbers that get stacked up and which get clearly played out over a quarter and on a yearly comparison, on an earnings perspective, really get reflected in price volume action, which was the case with Divi's Lab as well. So I think with this, we conclude part two. The part two was, as I said, about the different crises and how different leaders emerged. We will in a minute begin with what part three is all about, the current crisis at hand, what are we encountering at this point of time, and the way ahead on how to look at the markets from an own lens. In the next 20-30 seconds, I think we'll start off in terms of crisis at hand and the way ahead. Sure. So I think we'll start off with part three. And what is this unique situation that we are facing with? This is not a financial crisis or the financial crisis that we experienced because of classical financial deleveraging during 2008-9. But what we are seeing is the panic and fear that has got created because of the coronavirus pandemic and one really is not sure in terms of how and when this contagion will end. So it all started off in China, or as very well it is something that we know from media reports, at least at this point of time, and it's started spreading from there on. So Western Europe, the number of cases that get reported, the number of deaths, unfortunately, that get reported from Italy every day, every week, the contagion effect that we've seen in a lot of Western European markets, including Spain, including Germany, including the Scandinavian countries, including on what cases are getting reported into the United Kingdom and North American markets as well. I think the scenario in terms of the curve, and you must be reading a lot of articles in terms of how this curve is playing out. Obviously, the curve for China and South Korea was in a very, very significant 90-degree angle for the first few weeks of the epidemic that played out, but it started tapering off over the last few days and weeks. Now, the curve in terms of the contagion spread for Western Europe and the US markets are clearly on the rise. So the markets are extremely perturbed at this point of time on how this will get played out. And nobody's really sure in terms of how much of a risk are we still factoring into. So I think this is the large unknown that the markets will not like. I think this is a huge overhang for the markets. And though I think a lot of financial stimuli packages have got announced, which I will put forth in the next few slides, I think this is the aftermath that we are talking about. So yes, there is going to be an economic fallout because of the shutdowns that we've seen. China was largely shut down. There will be supply side constraints because of the factory inactivity from China. A lot of companies, including Hero, TVS, have clearly mentioned that the supply constraints for parts will actually hit 10-12%. There is a ray of hope in terms of factories actually starting off, and that is what we are reading through in papers at this point of time. Ports starting to clear off a few of the stuff that had got congested at the Chinese end. But largely, again, I think how does the entire world cope with this? Because if Western Europe, if North America goes into lockdown, and we're really not sure in terms of how long this lockdown will last. The of this to sustainable recovery. I think its extents further. Cases keep on increasing at a pace that is not known. I think that is a risk that we are probably exposing ourselves to at this point of time. So I think the budgeting in terms of protecting industries, in terms of protecting joblessness, in terms of payouts for any layoffs that happen, or payouts for any sectors which are feeling the pain, including aviation, healthcare, hospitality. I think those will be secondary effects at this point of time. So I think the large unknown and what we saw during the previous epidemics, I think this is something that we've not witnessed at all. So I think we put down the various epidemics over the past few years and the market reactions, both from a US perspective, which includes the S&P and the Nifty, and the various epidemics at play. So when SARS happened in 2003, again, I think it lasted for a good 2 to 3 months. The correction for S&P was close to 10 odd percent, and the Nifty corrected 13 odd percent over that time period. When the next outbreak happened, MERS, I think S&P was largely unaffected. In fact, Nifty corrected just 7.5% during that time frame. When Ebola happened, again, I think the S&P did not react. In fact, it had a 2% positive move during the time period of that crisis. But again, I think the Nifty moment was quite moderate enough in terms of correction of 5.5 to 6 odd percent. Now, when Zika happened, which was the last known pandemic that we announced, the S&P correction and the Nifty correction was similarly at par of the epidemic. Now, during the coronavirus epidemic, yes, markets were at an all-time high. Asset inflation, specifically in terms of stock prices, were at astronomical levels. But the correction, which is still continuing into the markets, and the pandemic by no means has got over, as I said, because the curve probably is still expected to get on the higher side. The S&P has actually corrected 30 odd percent. The Nifty has corrected more than 30, 34 odd percent. So I think the correction is probably take the market low that it did. move that both indices have done at this point of time, and in a relatively shorter time horizon. So I think these previous pandemics took the time, and the markets also took into cognizance on what is happening in the period of time. Now, when the curve starts flattening out, once it hits its peak, hopefully over the next few weeks, and it starts flattening out and starts its downward slope, that is when the markets will start realizing how and when the markets might have really found an end to its volatility. So the entire concept, as we discussed in part one, will become very, very critical over the next few weeks in terms of the rally attempt that the market will try to do, and in terms of trying to find its base, and again, I think in terms of trying to find the follow-through day. So largely, again, I think the hope is that over the next few weeks, as the curve starts peaking off, the economic announcements, as I'll take you through the next two slides, will start coming into play. They've already started coming into play with central bank actions, with a lot of liquidity into the system at this point of time, with central government actions in terms of providing support in terms of tax rebates, tax cuts, financial rescue packages for stressed sectors to take care of people who are probably getting laid off during this entire scenario. I think all that will start coming into play. Global GDP is obviously going to take a hit. So the IMF projections have started trickling through. If this continues, and obviously I think quarter one numbers will get hit. To a certain extent, quarter four numbers in an Indian context, I think the inventory was still there. We were largely not shut down for a better part of this quarter. So largely, again, I think we should have a stable earnings, a little bit of an earnings cut for a few sectors like aviation, hospitality, which have probably felt the brunt, movie exhibitors. But largely, I think other sectors might escape through this quarter. But I think the hit is definitely going to come through from an earnings perspective in Q1. So the GDP numbers have got downgraded for the global economy, for respective countries as well. The annualized earnings will also get recalibrated, readjusted, and therefore I think the Nifty forward valuations will also get adjusted. So largely, I think all this context needs to be put into perspective at this point of time. But compared to the previous pandemics, again, I think what this chart is clearly trying to show is that this is something which has not been seen. And again, I think the tsunami is being seen, but we can't do anything about it, because I think even to find a vaccine or a cure is going to take time, and that is where the markets are a little bit jittery. That if this gets out of hand, we're probably seeing greater economic lockdowns. And as I said, this is the first time when you're probably seeing economic and financial deleveraging happening simultaneously, and that is why the markets are reacting to the way the way they are. So as I said, you're probably coming into the COVID-19 or the coronavirus shock at this point of time. Now, what also has probably prompted a lower expectations in terms of GDP is also the three C's that I mentioned earlier. So Corona is the biggest culprit at this point of time. Obviously, as demand starts faltering away, the gas demand and the oil demand also starts tapering through. Russia obviously did not cede through Saudi Arabia's request in terms of cuts. What you saw in terms of the non-negotiations that followed was that Saudi Arabia cut oil prices. Oil prices are hovering between $25 and $30 a barrel, and that's not good news, right? Because I think lower crude prices obviously indicate that there is lower demand. The supply is going to be huge. U.S. shale producers again produce at a higher cost at this point of time, with demand tapering off and with production still remaining extremely high and crude prices remaining low. I think that also added to the added pressure and panic that the markets witnessed. To add to that, I think we had the credit risk aversion that played out for our system itself. Liquidity was there. There were no two ways about it. There was genuine demand issues for the Indian context itself, specifically in the aftermath of what we saw with the ILFS crisis. Again, I think the averseness in terms of lending to lower rated corporates was getting typically played out in the Indian context, and that really hampered our credit growth. What did not help in the past few months has been the PMC bank crisis on the cooperative scale, and the crisis in terms of the Yes Bank fiasco, which has happened over the past few weeks, which has led down to jitters within the financial system itself. So look at the Nifty Bank movement over the past few weeks. It has been a horrendous move because I think the expectations that market participants have, which is the next year's bank, if that scenario is going to pan out, whether there is an asset quality risk that we are probably staring at, unsecured lending, the retail lending within the unsecured space itself. What if we are entering into a phase where there are lockdown, joblessness, and whether these secured lending mechanisms or the unsecured lending mechanisms actually start coming off and asset quality pressures start playing over. So largely, again, I think the three C's, as we call it, Corona, crude, and credit risk averseness, have clearly rattled Dalal Street. So the COVID-19 shock and the global GDP growth, as you're pointing out, I think we've also got downgraded in terms of our own GDP for the coming fiscal, as has been the globe. So we will limp back slowly and steadily. Our global strategist and our global head of research has actually compared the US market fall not to the 2008 crisis, but to the 1964 fall, to the 1974 fall in the US market, and the 1987 fall in the US market, which had huge declines of 35-40%. And where I think the belief is that all these falls had similar attributes to fall like this. There might be some way going ahead, as I said, for the fall before we find a market bottom. But again, I think we're not expecting a V-shaped recovery. I think it's going to be a very, very slow, a U-shaped recovery for the markets. Certain sectors might have tremendous growth going forward, and that is where we should identify once the market throws us data points relevant through price and volume, through the rally attempt days, and through the follow-through days. So I think the next few days becomes very, very critical through data points thrown in the market. Now, this is the stimulus and rate cuts that a lot of different countries have actually thrown out. A lot of proactive measures and steps have been taken. A few central banks have cut rates, right? So US has actually come down to 0 to 25, 0% in terms of interest rates. Australian central bank has cut 25 bips. The South Korean bank has cut 125 odd bips. So there is, with the liquid rate cuts, I think a lot of liquidity that is available for a lot of banks at lower rates available to them at their disposal to probably look at the discretionary needs for general economy as a whole. Apart from that, I think look at the stimulus packages that have got announced. So the US that has announced a stimulus package so far has been 4%. I've missed out Canada here, but Canada has done a stimulus which is almost 3%. China has done almost a 0.8% of its GDP. The Japanese central bank, apart from what has not got mentioned here, has done a huge amount in terms of repo purchases, and so have UK and Australia in terms of stimuli. France also has announced a huge package. So I think a lot of these economies are cognizant of the economic fallout, as I said, of what will follow once this pandemic over the next few weeks has been controlled. And that needs to be taken care of in terms of economic payouts, tax rebates, tax reliefs, in terms of supporting the mechanisms, in terms of getting a lot of these MSMEs and small businesses back on track, and a lot of the front-facing businesses which will get impacted by the crisis the most, as I've been time and again mentioning, airlines, hospitality, leisure, back to their feet and supporting them during this time frame. Now, classical expectation in terms of finding market bottoms is earnings yield and bond yields. Now, when the earnings yield and bond yield actually flattened out or have a linearity, I think that is where generally market bottoms are formed. If you probably are looking at the past three crises at hand, or the last few crises in general, I think the markets have largely reacted to this number very, very closely. So once the bond yield and the dividend yield, I mean the market yield start coming and the earnings yield start coming together in a flat linear line, and that is getting played out through the red line that is getting displayed, I think that is where I think the bottom of the market is closely. So largely, again, I think that is very, very close at this point of time. So are we very, very close to the bottom? I think the rally attempt and the follow-through day will let us know. So I think keep this indicator in mind as well, because this is a very, very key indicator. We're very, very close to that at this point of time. And even the forward multiples is one of the indicators that are used. In the previous bottoms, forward multiples had shrunk between 15, 16. We're very, very close as well, but we do not probably, as I said, follow the forward Ps, because ultimately I think it's a function of our earnings is. Large expectation of the market, as I'm time and again saying, is Q1 numbers are expected to be soft. which means that the annualized earnings will come off significantly for a lot of companies this time around for this annualized year as well. So you need to adjust that earnings mechanism, but which companies will grow, where the earnings will stack up far better than the others, will get thrown out through our sector rotation graph, through our earnings mechanism, through our evaluation tools on our products and markets with an algosmith, and that itself will be a lead and a key indicator in terms of stock picking, stock selection, once we form a reasonable amount of base and getting into the rally over the next few weeks as it follows and when it forms. Now, crude price, as I said, I think that's beneficial from an Indian perspective. It has actually come off significantly at this point of time. Now, there is a general thumb rule that one deploys into the market. So a reduction of 10 barrels, and the reduction has been quite substantial over the past few weeks, helps and cuts India's import bill by $1 trillion odd rupees. So the trade deficit and the current account deficit that we probably witness comes off significantly with the price in the decrease that we've seen. Unfortunately, I think what you probably saw is that the excise duties got increased, but largely again, I think the overall basket has come off. Crude OFCs have probably reduced prices over the last 2 to 3 days, as I've seen that, and that is a huge sign and a huge relief from India's trade deficit and current account deficit perspective. There are numerous questions that are getting. There are articles that are being displayed. Now, a technical recession is already in place, because if a market corrects 20% from its all-time highs and probably stays there for a few days, which it has. If you look at the Dow, you look at the S&P, you look at our own indices, or if you probably look at any of the indices for that matter, I think the 20% fall has probably taken place. So the technical indicators are in place at this point of time. The fundamental indicators probably are that a couple of quarters where your GDP numbers start trending downwards, which are also an attribute in terms of subsets thrown out through the PMI numbers, through the IIP numbers as well, which also show a declining trend. And a reading below 50 consistently over 2 quarters also gives you that sign. So yes, I think from a technical perspective, from a fundamental perspective, let us admit to the fact that we are probably facing the brunt in terms of asset inflation and asset prices cooling off from an equity perspective. So is a recession coming? We're probably in the middle of a recession right now at this point of time. Crude prices, again, I think a key parameter there. I think with leading crude prices going off, demand tapering off. Look at the bond yield movement again, I think, because I think all these 3 parameters, 4 parameters need to be observed very, very carefully. Bond yield, earnings yield movement, the PEG growth parameters going forward, the parameters related to how crude prices are functioning at this point of time. And fourth, I think in terms of the index movement itself. So I think some or large part of it is that GDP numbers have got downgraded. A lot of events are getting postponed all around the world. There is an Olympics coming through as well, which could have added substantially in terms of the Japanese GDP. For some reason or the other, at least at this point of time, unknown, but if that it gets deferred, delayed, or postponed, I think you're probably looking at a huge hit coming on the Japanese economy as well, which again have an impact in terms of how global GDP is. So I think we're in the middle of a recessionary trend at this point of time. We are in the middle of a bear market at this point of time. So to be very, very clear, I think not to be adventurous in this market, as they say in Hindi, Robin Hood बनने की ज़रूरत नहीं है. I think you don't need to be adventurous in terms of trying to bottom fish into the market. Let the market give you indicators and let that indicators get played out to market data, both through price and volume action points. And that is where we'll try to seek actionables in terms of buying points. Now, how are we looking ahead? As we said earlier, we look out for those first 3 days, 3 critical days of the rally attempt that the Nifty will make. Once that 3 days are determined, and during those 3 days, the Nifty does not undercut its low that it has made from day 4 till the next few days, till day 25, we will actually wait out follow through day, which is a Nifty movement of more than 1.5% to 2%, with volumes more than the previous day of when it does that 2% move. Now, once that happens, I think we will start getting into stocks which display the best moment across sectors, which again get thrown out through our products, markets with India, Algo Smith, through our sector rotation graphs. We will get an idea in terms of the sectors at hand. Once these days are happening, the stocks will get reflected very, very clearly, and then we will take aggressive positions in these stocks, which can deliver better returns than punting at this point of time and trying to get into the stock at every dip, because it's not a dip that you're seeing. How deep the market correction will be is nobody knows and nobody's guess at this point of time. So let's not do second guessing at this point of time. Get into 10% or 20% of stock selections at every dip that you see, because I think the market needs to find the base, which can be very, very effectively found through the mechanism that we followed. And this has been time tested for all the market participants, just for your information, over a period of time. And these time tested models have been put to work through our products in market space analysis. So this is how we look at the markets moving ahead. So I think we are largely done. I take a break for 2 minutes. After that, I think any queries that we've got, we can answer your queries, and we will take it ahead from there. So I think a 2-minute break at this point of time. You can stack up your queries till that point of time, and we'll try to answer as much as possible. Hello, everyone. Thanks for your patient hearing over the past almost 2 hours. So yeah, there are quite a few questions that a lot of participants have. So I'll be joined by my colleague Rushid, because it will not be possible for me to answer all the questions at this point of time. So we'll try and answer. We'll try to answer most of the questions. In case we are not able to answer your questions, I think please excuse me, because I think time probably is not permitting me, but I will individually answer your questions. We'll take down your questions and answer them to the extent possible in a very short period of time. Yeah. So I'll start answering questions. I think Rushit will take over first for the first questions. I'm stacking up the questions that I can answer. Yeah. Thanks.
Hi everyone, Rushit on this side. So there is one question regarding the group ranks, that how to use the group ranks. Should we focus on the leaders within the high group rank in terms of EPS or RSI? So generally, this is a very important screening when it comes to looking at the top industries. So I think Mayuresh discussed a lot about what happened in previous crisis, which groups were leading the way ahead. So this is where group rank comes into picture. Say for example, if you are looking at some HDFC bank, or if you are looking at some chemical companies, then always prefer looking at the group ranks. So it indicates how that group is performing comparing to the entire general market. And yes, once the group rank is higher, then within the group you should shop for the EPS or the relative strength ranking. So that is a better way to move through.
Yeah. Thanks, Rushit, for that. So there's a question from one participant, Disha. She's asking me if you can explain the crisis in detail, right? So if you can dive deeper into the bond yield, earnings yield, and its relation with the market movement. So Disha, what happens clearly is bond yields actually start giving the signals first. So any signal in terms of the macroeconomic indicators that get thrown out are reflective in terms of the bond yield movement itself. So the short-term duration bonds, the long-term duration bonds, and the yield curve, as we call it, has different scenarios built in and pegged in towards different scenarios that will happen across a different periodicity of time. Now, the earnings yield is nothing but the earnings momentum that the index stocks have, right? Now, typically that you've seen in the last few bottoms, or when the last few bottoms happen, and again, I think the hindsight of all these studies itself, not necessary that it has to get repeated, but the hindsight of a commonality in all these studies is that once the bond yield and the earning yields become very linear, right? It is a known fact that at that time the market bottoms have happened very closely, plus minus 5% to that. We are very close to that. But this scenario is very different because I think there is huge fear and panic in the market, and people are actually throwing in the towel at this point of time. So I think they're not looking at prices. Look at the VIX. I think this is the maximum moment that the VIX has seen ever since the 2008 crisis. If I'm not mistaken, during 2008, VIX had scaled up to 80, 85. We were almost there at 72, which cooled off a tad bit. SEBI has just put out a circular, but till what extent is that going to help? Because I think a lot of FIs can actually push through their positions and sell off in the cash market as well. So I think it needs to be seen. But currently, I think the bond yield, earnings yield is at a linear perspective. When you talk about the forward multiples, I think the earnings, as I said, is a slave of the forward P's are a slave of earnings. Now, earnings will come off because Q1 numbers are expected to be soft. So annualized earnings will come off. So the forward P's will also get adjusted accordingly. So our own methodology at William O'Neill and Canslim is that P's is nothing but a function of earnings. So I think it's better that you concentrate on earnings. And if the growth is coming through, right, growth in terms of top line, growth in terms of EBITDA, because of the efficiency shown from an operating leverage perspective, I think the EPS itself will be a key indicator of that stock going forward. But there is a different take to that as well. One might argue that there have been tax cuts, and a lot of companies might exhibit that in terms of larger profitability as well. Agreed. But I think if you probably go through the entire cycle, the EBITDA performance also becomes important in terms of expecting how the generalized bottom line growth will be. So I think both these factors have a very important relevance. So I think this is how I would see that. So I think I'll request Rushit to take over the next question.
So there is question from Vikas that when do you see the bottom forming? So Vikas, as Mayuresh already discussed, that we are not in the game of prediction. We will not never try. I think the best in the world are not able to assess the damage cost. with this coronavirus, how this will impact the economy, how deep this will penetrate among the countries, among the people. So it is too early to, and all, we should not go in the game of prediction. But yes, we will always look at the how market is behaving. So as we explained, we will look at our methodology, the market M factor, that is the bottom forming market attempting a rally. We will look for the follow through day, and yes, not only we will look for that day 1, day 2, day 3 follow through day, we will also be looking at the leaders. So what are the market leaders doing? Are they able to retake their logical support levels? And how is the broader market performing? How? And so these all factors when we club up. So just give market the time to show the strength, and will not try to predict when the market will show the strength.
Thanks, Rushit, for that. There is a market participant who's asking. I think I forgot to. I briefly mentioned that rule that uh, we've got a 8% stop loss rule. Now our product, right, Markets with India. As I said, I think the sector rotation is thrown through our product graph. So I think we will have that put forth as well in terms of the mail that we'll put forward once this session is over. In terms of which sector rotation, as per the sector rotation graph, what is probably looking very attractive, which needs to be kept on your watch list. But the 8% rule is that if you enter the stock at the right pivot level, so Markets with India as a product, right? Once we have identified all these trends from a fundamental and a technical base formation perspective, I think you should be entering a stock at an appropriate pivot level. So the market, the product, the Markets with India will actually throw the exact pivot level that you should enter the stock, and we've given you a very nice leeway. So I think between 0 and 5% of that pivot level is when you should ideally enter that stock as per our evaluation tool on the product itself. So 0% पे अगर आप enter करते हो, so an 8% stop loss rule is mandated because there might be some changes that might be happening either in terms of volatility in the market movement, but we are in the process of identifying that your capital should get protected. Second, अगर आप 8% का rule नहीं रखते, and Venu has probably replied very smartly on that, right? So if that 8% is not done and you just keep your position open on the downside, say the stock corrects in a market condition like this, right? And I showed you the Nifty chart from a week's perspective to a month's to a year's perspective, and the correction has been brutal across sectors for the leading Nifty stocks as well. So, for example, if they correct 50%, and if you not kept that rule, and it has broken through all key averages, imagine, I think, for the stock to achieve your break-even point would need a 100% rally. So, I think that is what the extent is in terms of such corrections and why that 8% rule is kept. So I think this is very clear that you should enter at the right point of time. The 8% rule has to be followed, and you should not be entering in a stock at an extended level. So, for example, I think if a stock is moving and you probably enter the stock at a 10% or a 15% move, I think that is not the ideal way to look at a stock because I think it's an extended move. At that 15%, you might have intermittent days where that stock might correct actually 7-8%. So you might get actually stopped out because you have kept your entry point which is higher, which is not at the desirable level. The third element that I want to put forth, since I've got this opportunity of discussing the 8% and the entry point rule, is that you should be booking profits at that 20-25% level if you have entered at the right point of time. Why? Because I think at every time period, you will get new set of stocks which will give you that entry point. Rather than betting onto a stock which are below 2025, and there will be few exceptions from there as well, right? The stock keep on continuing its upward move, but there again, I think you have to have some rules in place. So I think having rules in place when you are buying, that once 20-25% is hit, you probably take money off the table in a gradual fashion or in a complete fashion as well. Get into new stocks which have shown better bases at that point of time, because it is evident that in a few of these cases or a majority of these cases, once that 20-25% move is done, that stock actually moves sideways. So that time-wise move that the stock does, I think there will be there will be better stocks in that period which can actually give you that move. So playing out in this manner can give you better ROIs rather than holding out. As I said, there will be exceptions, and there are exceptions in the past as well. We have personally witnessed that ourselves. So in alkali amines, for example, we had taken positions, we booked profits, and the stock kept on moving higher. But I think that's the way the markets are, right? But you need to have your buy rules in place and your set rules in place. So that are also very important. The buy rules are given out by the product itself through the evaluation tools, which are calculated fundamentally and technically. If you follow the product itself, I think you will be far better off. So I think you need to follow all these rules very quickly. I'll give it to Rushit to answer the next question.
So there is one question from Surinder Singh, very important one. How to identify stocks who are going to lead the next rally and who are going to be the laggards? So Surinder, in this case, uh, you always look for the base formations. Like we always talk about the cup with handle base formation, double bottom base formations. So which are the stocks that are consolidating as of now? And as William O'Neill has always said that whenever the market turns higher, the stocks which tends to lead the market are the ones who are going to give a good returns over the next 2-3 months. So say for example, if market starts back its rally in next month, and you see that these are the stocks among the Nifty, these are the stocks among the broader indices that are leading the way. They are retaking the key moving averages, the ones they have consolidated during the market correction. And yeah, this is also a good time I discuss about the volumes. So you should also know about accumulation and distribution. So whenever the stock is going down, say for example, the correction is severe this time, and if you find that stock is correcting a bit lower volume, or you can say just before the market started its uptrend, then the volume will be dry up in those particular stocks. The selling volume will be very less. Someday you might see a big spike in volume when there is a up day. Say for example, yesterday was a up day, and you see a stock with good buying, and from for next 2-3 days, just in case if market goes down, and you see that stock is moving down a lower volume. So yes, these are the stocks where quality investors who are long-term investors, institutional investors, they are intact in the stock. Only the weak investors are getting shaking out. And whatever we have observed through O'Neill, that these are the stocks who tend to lead the next rally. And yes, whenever the next rally starts, you can just go to Markets with India and screen the stocks according to their RS strength. So the stocks showing the higher RS strength, like more than 80, 85, 90, these are the stocks that are leading the market. And if those stocks follow the other Canslim parameters, that is the point where you can enter that stock with a correct buy point. Most important one, correct buy point. Yeah, over to you, Mayuresh.
Rushit, you can take one more question now.
Sure. So there is one more question regarding the base formation. So like during the like when the market will rebound over the. So yeah, as Mayuresh already explained through the slide. If you can, Mayuresh, just to get that slide out, then I can explain it a better. Like the first one about the market directions. Yes, yes, this is the one. Okay. So let me annotate this one for you. So whenever, so like previously we were in under pressure, then we went to correction when the big fall happened due to the rising corona issues and all those things. So now we are in correction. So what you need to look for is the day one, day two, and day three. So it is clearly explained that whenever the market starts forming a bottom, say for example today the Nifty level is around 8,200 or let's say 8K. Okay, and for next 2 days, whatever be the volume, whatever be the up or down, say for example, if the market opened higher, it went down, but the 8,000 level is not breached, then this is the important level. The day one level is always important. If this level holds for 3 sessions, then logically it means that market is trying to form a bottom. That 8,000 level or XYZ level is giving a good support to the market. And this is the point from where the market is trying to rally. However, we will never tell that this is the bottom. This is just a potential bottom. Okay. And when will you confirm that this is not a potential bottom and this bottom has a capacity to start a new rally is a follow through day. This is FTD. So whenever the market is in rally attempt, you see a follow through day, and that is when the market is in rally. Here also, I will make a red signal for you that not each and every follow through day works. Okay, and that is why William O'Neill always suggests to go for a pyramiding strategy. Don't put all your money at once, man. Go for some 20% at the first, then 30%, then 25%, then 25% again. As the market gains strength, you put the money. So we are never into business of catching the falling knife. We don't like to do bottom fishing. What we like is buy high, sell higher. So that is why after a follow through day, wait for market to show strength. And as a particular stock, the particular indices show the strength, you start follow up buyings as well. Yes. So I told that not every FTD works, but you should also remember that no rally. I'm not talking about India. I'm not just talking about the US, but globally. Since last 50 years, we have been researching on this data at O'Neill, and we have found that no market has ever started a rally without a follow-through day. So yeah, these are a very strong indicators, and it's very important to follow at this point of time when no one is able to decode the situation in the market. Over to you, Mayuresh.
Thanks, Rushit, for that. Uh, uh, Let me see, just a minute. Yeah, so quite a few queries in terms of this entire presentation. Yes, I think we can share this to you. We've also done a very interesting work over the last few days. So me, Rushit, Satya, the entire research team, Rajshekar, have worked on the previous crises at play, detailing in terms of uh, how the entire scenarios have played out. I think it's a very, very interesting report. So I'll ask the team at, I mean, our marketing team to probably send you those links. You just need to register yourself very, very quickly. You are not registered users, and you'll get that report. So I think that can be followed very, very clearly. Okay. Just take your question. Give me a minute.
Yeah, by the time Mayuresh takes a question, just a comment in between that there are a lot of questions like people are discussing in the chat about the sell rules that what I see. So yeah, you can to get an exact idea about our sell rules, you just go to blog of MarketSmith India or our YouTube page of MarketSmith India, and there you will find our past webinars where we explain the sell rules. We also explain the market condition, and in the blogs, like every week we continuously put up something over there. On every Saturday you will find something over there, and there are a lot of content in the blog regarding the chart patterns, regarding how to identify bottoms, and there are a few examples over there. So yeah, just visit that page and you will get exactly the idea, because explaining that would take a whole hour for us to that what are the sell rules, what are the buy rules. But yes, you go over there. If you have any queries, just post it to us, we will get back to you. Over to you, Mayuresh.
Thanks, Rushit. So Gurdeep had a question. So Gurdeep has asked if one index is hurt the most, then would it bounce back the most too? So I think the entire purpose of showing you the crisis years and which indexes had fallen and which indexes took the market leadership position, I think let us not presume, right? So we are not into the presumptive process that if one index has got hit the most, say during this crisis, the bank index has got the most, whether it should bounce back the most as well. I think let the data points get thrown out correctly by the market itself. There will be some sectors, as I said, where there will be a V-shaped recovery because of the expectations that earnings will come back faster for them. But let it get thrown out of the market. So I think let's not presume that. Whatever data points get captured through our sector rotation graphs, I think we will have key sectors that will come out in the top quadrant. But we will move as the market moves. So again, I think at different periodicity of time, once the market, as Rushit was explaining, right, once we go through the rally attempt and into a confirmed uptrend, I think a lot of sectors will start moving simultaneously at that point of time. Now, within that, I think which sectors are showing greater earning strength, which sectors are showing, and stocks within those sectors are showing better base patterns and price movements, both from, as I said earlier, from a price perspective, a volume perspective, the RSI indicators as well. I think that all gets thrown out from the system itself. So what we need to do is identify at that point of time, looking at all these parameters, but not presume that if it is hurt the most, it will bounce back the most. This is also a different presumption on that matter, as I've been at the risk of repeating myself. कि यार market बहुत गिर गया है तो यार 10% लगा दो यार. So I think the market has been so volatile and so choppy in the last 10 days that आपका 10% अगर आप लगा दे जाते थे हर call पे तो I shudder to think where you are at this point of time. But largely, I think just follow this. I think this mechanism probably has been working in a time-tested manner for a period of time. So I think it's not necessary, Gurdeep, that if one index falls the most, it would bounce the most. You've seen that in the past as well. I think different sectors and different stocks within those sectors takes leadership position. Rushit, over to you.
Yes, so I find one question regarding this PVR, Inox, that they are for down a lot of like 40-50% they have corrected. Even IRCTC, like a very hot stock in the last month, even a lot of people were discussing around that. It reached 2000 and now it's I think in 3-digit yesterday. So there is one question regarding to it, that should we look at those stocks or it's time for them to be over in the market? See, no stock gets over like this in the market. You should keep following the stock. So I'm not telling that it is a good time to enter the stock or not, but you should look at the basic fundamentals as well as the technicals in the stocks. So due to this corona impact, people are traveling less. There has been ban over the entertainment industry and all those things. The cinema houses are closed, so they were bound to take a hit. But once the thing normalized, we need to observe the movement. Like the recent quarterly results will be out. You should look at the management commentary. What are they trying to say? Is government coming up with any stimulus for this aviation industry, for the someone like PVR, Inox? So you should club those stories, and you should look at the technicals. That are they able to retake their logical support level, 50 DMA, 200 DMA, and mostly like 95% of time they will form a base. And whenever a base is formed, Market Smith India's chart will always pick up those base, and you just keep on screening the base. That mostly in this high volatile market, what we have always observed, that a double bottom base can be formed. So the correction is dramatic and deep in these stocks. So there are chances that there can be a rebound when the things start to lower a bit in the corona side. And whenever those kind of dramatic higher moves also happen on the upside, there can be some 4 to 7 weeks of volatility in that stock, because weak investor might try to cut down their losses, or there might be some investors who are now at break even and they might be coming out of that stock. But at that point of time, you will find that the volume is a bit lower on the selling point, and that's how double bottom is formed. And once it breaks out and the fundamental is supporting, that is the point where you should start looking at those stocks.
Thanks, Rushit, for that. Pankaj Lada had a question, so I think he's got a couple of questions. One, I think the S&P, what I indicated, right? The indicators of 62, 74, and 87. So Pankaj, I think very clearly, if you're listening and hearing this, we will send you across the chart formations and what has happened, and the number of days it took to form the bottom, and the number of days it took from the bottom to the all-time high. So I think those charts will come to you. I think your mail would be with us. So I think we would do that. We have also had a follow-through in terms of the global GDP was down in 2008 by -2%. This time the IMF expects it to be positive 2%. See, largely I think GDP is a function, and it is an output in terms of how different industry sectors work together, and the combined output thereof is reflected in terms of the overall earnings potential for an economy as a whole. I think it's adjusted in terms of getting your parity through the PPP theory. So the purchasing power parity theory actually has GDP which gets normalized for a lot of economies at play, because I think there is a lot of intermittent trade action as well from an EXIM perspective. So IMF has cut down the GDP expectations. So I think it has cut down China's quite substantially. I think it has cut India's down by almost 50 odd bips to 5.1, 5.2 odd percent. So I think there is a outside risk. So whenever you're probably looking at that, it's probably a base case scenario right now that IMS is working with the data points that it has got, but it's also a moving part, right? So if this extends further, if there are further supply constraints globally, I think if demand contracts, you're probably looking at a scenario where GDP contraction can be even further going forward. So I think it's a moving part that they probably address. So yeah, that's an upside risk that we're probably looking at. But global GDP is, as I said, is going to come off. You can't expect that if a quarter's growth has probably got negotiated, it gets compensated in the next 3 quarters. I think it probably gets compensated to a certain bit, but not fully. So yeah, I think it is still in positive because I think global GDP is in positive terrain at this point of time. But there is a risk factor, as I mentioned, that the downgrade might happen if these elements move in the opposite direction going forward. Yeah. So we will forward you the entire charts. They are all there with us. You will get them on your email over the next few hours. Yeah, thanks. Rushit, over to you.
Yeah, so there is some discussion about the PEs in the chat box. So, see, MSI, William O'Neill, we never considered PE as a leading indicator. So, it's not a good thing to just bottom fish based on the PEs, because what goes lower generally goes lower. And if something is coming at a cost, then it's obvious that quality demands a premium. And that's why those stocks will always have a higher PE that are going higher. So just a few examples like DMart, IRCTC. So on the listing day, DMart had a PE of some 60, 70 at that evening, and people were telling that's too high and it can't go in 4 digit and all sorts. But even in this critical time, I think the DMart is around 2000 level and the PE is more than 100. So it's not like the higher PE stocks will hit the most or the lower PE stocks will lead the next run. It's a, it's not true thing. You should always look at all the other indicators. The growth stock will always have a higher PE, and that you need to accept. You can't go with some stocks with a PPE of 12, 15. Yeah, we respect the conventional method, but that is not what our method is. We look at these stocks that are going higher, that are at 52-week high, that are at lifetime high, because that are the stock where investors are having the interest, the buying is happening, and what is going lower, you will generally see that goes lower. Over to you, Mayuresh.
Thanks for that, Rushit. Just a minute. Yeah, so I think there's a question from Harsh. So I think what he is asking is, for the benefit of everybody, according to Canslim, when we find rally attempt and uptrend, is it good to do value hunting, as many good stocks are available at a very low P and price to book value? So Harsh and everybody who's listening, I think we are not in the process of finding value in the markets, right? So our methodology is very, very clear. We are looking for stocks which have growth indicators in them. We are growth investors. So if a stock exhibits the right attributes from a growth perspective, so as I said earlier, each attribute within Canslim has a certain meaning attached to it. So if the revenue growth is exceedingly strong, exceeds more than 20-25% consistently, if the earnings growth is consistent on a quarter-on-quarter basis, on an annualized basis of more than 20-25 odd percent, if the institution holding in that stock is increasing, if the stock has the newness, the N factor to it in terms of newness, new products, new initiatives, whatever it is, and the leadership position is maintained, I think if most of these attributes which are captured in terms of the stock price and the attributes which are captured in terms of the quality of earnings that the stock displays, I think P, as Rushit was explaining earlier, right? I think we look more from a growth perspective on all these attributes. And though I think a lot of stocks will be, from a value investing perspective, will be attractively placed. They are even right now, right? So I've seen multiple questions in the chat box in terms of OMCs and a few of the PSU banks. I think the price multiples remain cheap. I think give you clear examples in terms of say PSU banks. Leave aside SBI for the time being. But if you accept XBI and ex-SBI, if you look at the PSU banks, I think they've been awfully cheap for a period of time, and they have remained cheap for that periodicity of time over the last so many years. I think we have gone through different cycles in terms of asset quality pressures, lending issues, capital adequacy issues, management changes, mergers, you name it. But the valuations have always remained very, very, very low. So does that mean that there is significant value? There would be, and there is. So there is no two ways about it, right? The properties that they're probably having at this point of time, the databases that they've got. But it is not an indicator because the markets are clearly throwing out that low P, low PB stocks in every case doesn't work. A few cases, yes, value hunting, where I think a few qualitative stocks which have corrected significantly in the market correction, and where there is a ample scope in terms of them regaining their market leadership position, them regaining their earnings pedigree, where corporate governance and management pedigree has been top notch, but because of market conditions they have come off. I think those stocks, yes, they would make sense. But our philosophy, as I said, I think is that if you probably look at the growth angle for these stocks, I think the kind of ROIs, as I mentioned earlier as well, right? I think if you follow those rules very, very clearly of 25% booking profits, then probably getting into stocks which are exhibiting all these traits combined together, getting into that and riding on back of that, I think it would make more sense in terms of the X of the returns that you make over a longer period of time. In terms like this, is value hunting suggested? My own sense is that we've discussed this in detail, right? How long this will last, how a bottom is formed, nobody knows where the bottom is, right? It's only in hindsight. But at least this methodology gives you a fair idea that you can actually gauge the market mood, the current movement. And if you follow this process, which has been back tested, as I'm repeatedly saying, I think you've got a decent enough chance and probability that all these methodologies will work in terms of your ROI far better. Yes, value investing in some cases might work, but I think we are growth investors. We don't. Over to you, Rishi.
Yeah. So Naren has a question that why is it not possible to decide if the market falls 5% off highs, we should sell our portfolio, and that is how we can save our money. So Naren, every time the market makes a high or it goes to a certain level, there can be a small pullback of 4 to 5%. There can be profit booking. So these are not market corrections. Yes, certainly you should look at the other indicators like distribution day, which we discussed in detail during the webinar. What is the level of 50 DMA, 200 DMA? Is there is a clustering of distribution day? So yes, if there is a clustering of distribution day and market is coming off high, then that is a good indication that you should start trim your positions. But taking 5% index off high is not a prudent move in the market, because if the market is becoming choppy, then there are chances that after some 5-6% pullback or a small profit booking, there can be a big up move also, and you will get trapped in that. That after you sold everything after a 5% pullback, and then if market goes back up, then you will be thinking that okay, I need to enter it again. And there is always after market reaches a certain level of height, there is a 2-3% of pullback again for profit booking and many other factors. So we should not get trapped in this. We should focus on the particular stocks, that how the stock is behaving in the market. Has the stock breached its key moving averages? Stop loss of 8% you should follow. Yes, one thing you can do is, like, if the market is 5% off high, showing the sign of distribution, you can trim your position. You can start booking profit in the stocks that are already up 15, 20, 25%. And if you think that a particular stock is a bit down 4-5% and showing some weakness, say for example it is going down on higher volume, so that is where you can sell that stock. So it should be stock specific decisions, like how during this market drawdown, when we saw the clustering of distribution day, a downside reversal. So the portfolio of Market Smith India, which was around 20 stock, was down to 10, then we were down to 5. And after the 200 DMA got breached and there was no sign of a good reversal in the market, we are sitting in a cash. So this is how gradually you should, like, whenever you are entering the stock using pyramiding strategy, and whenever you are exiting also, you can trim your position gradually. And I think that is the correct way to be in the market, rather than taking this panic decision of exiting the portfolio with just 5-6% of indices off high. Over to you, Mayuresh.
Thanks, Rushan. So there's a question from Harsh. I think it's relevant. Suppose there are 2 to 3 stocks from the same sector, which are all showing good growth attribute and eligible to invest according to Canslim. How do you select from the three? So see, we don't have any bias towards a particular sector and stocks within those sectors, right? So I'll give you a very key example. In the rally that was there over the past few months, specialty chemicals was something that was doing exceedingly well. So I think we had different positions within the portfolio from specialty chemicals. So I will name a few stocks which we owned, which we suggested at that time to buy, when we booked profits once it hit our profit taking rules. Alkali amines, Deepak nitrate. So I think a few of these stocks were there, which were there from the chemical industry itself. And we rallied that, and we went on that fact that I think the sector was showing improved synergies, and all these stocks were showing brilliant patterns. So I think the attributes that were there from the methodology perspective, the earnings were solid, the leadership was solid, the institution ownership was solid, the market direction was in the right place for this stock. The price volume action from an EPS rating and an RSI perspective was also solid. So we are not biased. So I think what the system does, again, Harsh, is it takes the individual biases off, right? And that is where the biggest issue is in markets or general market conditions generally. I think whether it's a rally market and rally to attempt market, correction market, I think our human biases take over, which is not the case. I think this methodology, our products, I think take out the human biases out, and it actually gives you a clear indication on what market is throwing at you. So I think that is one important takeaway as well. I think keep your human biases away. I think a sector might actually throw up at one point of time a lot of stocks, and those stocks within those sectors can do phenomenally well during that point of time, because over a time period we've seen that some sectors perform exceedingly well and then other sectors take over. Yeah. Thanks for that question. Over to you, Rishi.
Yeah, so I again saw a few questions regarding the follow-through day, how the indicator it is for a next bull run. So there, we clearly explained. Even Mayuresh also discussed on that. I also told that it's not that every follow-through day works, but that is a very good. I think one of the best indicators that next bull run is to begin. I'm reiterating that you should take a pyramiding position whenever the follow-through day occurs. So now, what after the follow through day occurs? So the things are on the two sides. First, the market can rally, and whenever the market rallies, and if the rally is strong, we can see additional follow through day. Say for example, the market is in rally attempt day 1 to 3, and generally the strong follow through day comes from day 4 to day 7. So if the follow through day comes in that period of time, then it is really strong. And if the market has a good strength, then it will indicate from day 7 to day 15 there can be an additional follow through day. So every 7 to 8 days we will see that the number of follow through days are coming in the market, and that shows the strength. Parallelly, you should also look at the leaders in the market. Not just index gives you the clear picture that how is the broader market doing and not. Second thing, on the flip side, we should also track for the market weakness. So whenever we are in a confirm uptrend after a follow through day, and if you find that there is number of distribution days are increasing, say after a follow through day within the next 2 days there is one distribution day, and then the market is stalling, then there is again a distribution day. So yeah, these are the red flags which you should not ignore. The distribution days are really strong red flags, and that also soon after a follow through day. So in the beginning of a bull market, or you can say a rally, a confirm uptrend, you will always like to see that the market gradually moves higher or gives some strong momentum. But if you find that yes, the distribution days are increasing in this market, then that is a red flag, and you should not commit your more capital. So like if you have committed some 30-35% of capital in the initial days of a follow through day, you should stop over there and look for the market to give some more strength. So this is how you can go from the two side rally, and there can be other chance that the market can be back to under pressure. So this is very key when you are investing in the early stage of a bull market. Over to you, Mayuresh.
Thanks, Roshan. So Mihir had a couple of questions. Do leaders of the previous bull market correct less? in the correction. He actually gave a few examples like Alchem or Abbott, and do they lead in the subsequent uptrend as well. So I think the entire purpose here was to explain right from 2004 to 2020 that different set of leaders come through. So if you would have gone through the entire presentation, right, every crisis once it was forming, right, and once it formed the bottom and then the recovery process started taking place, there were initial leaders which corrected, and those sectors which corrected during that crisis period, not necessary that the same sectors carried on during the bull market. So new set of sectors probably took their place, and with that perspective, I think stocks within those sectors outperform the other sectors. Obviously, I think if you go through a special report, I think I will ask and request the marketing team to probably put the link. I think they've already put the link through here. It's just a small registration that you have to do. You've also laid out, right, that apart from these core sectors, the broader markets for each of these respective years, whether it's 2004, 8, 11, 12, 11 and 15, I think there have been stocks which have outperformed brilliantly in the broader market universe as well, right? So there have been cases like 74 or 78 stocks in 2004, some stocks which have given more than 300% returns at that point of time. But then again, I think the methodology is very, very clear. I think these attributes need to get followed. So I think the earnings are nothing but a slave in terms of how the entire company is performing, right? So if the company is being managed well, performed well, I think the earnings will be reflective of that. Certain stocks have moved because there might be low float or something like that. So not all stocks probably filter through the Canslim criteria, but there is also attached risk to that. So in rally attempts or bull markets, I think every Tom, Dick and Harry moves. But what do you need to select in terms of protecting your capital with your stop loss tool, and again increasing your stakes in sectors and stocks which are having leadership positions? Not necessarily that every stock should be having a complete leadership position, but they should be having niche businesses and leadership traits that can get displayed to that. So not necessary, as I'm saying again, I think that every leaders that correct lead the previous rally. I think that was the quote that I've mentioned very, very clearly. I think bear markets are necessary because they clean up the excesses, and they also throw in new sectors and new leaders which can be leading the new bull market that ensures and follows the bear market. और ये आप समझ के लेना कि bear market permanent नहीं है, bull market permanent नहीं होता है. So at some point of time, I think this market will end. The indicators will point to that, and once the bull market starts, I think you have to be present there to make the maximum of that rally. Follow those rules so that you can rotate through in terms of sectors, stocks within those sectors, and make the maximum out of it. Yeah? Thank you so much. Over to you, Joshi.
Yes, so there is some discussion about the recovery in the market. So, see, you should understand that the market sell-off has been very sharp and deep. So these kind of V-shaped bounces are reasonable. So like there can be some V-shaped recoveries. But what we have observed over the years that V-shaped recoveries after such a fall are generally not very constructive. Because see, I've coined one term, that is overhead supply, OH. It is very important to understand when the market have been corrected so deep. So whenever the market tries to cover a V-shaped recovery, so the stocks may be hampered by the overhead supplies. So what does this overhead supplies actually means? Like say for example, the stock is around 40% of its high. So whenever it tries to move up, so at some point of time it will find a ripples that yes, after some 10 12 15% of upward move, there the sellers might come, uh, those who want to cut their losses or those who want to break even. So at that point of time there will be again some correction in the stock. And I think this is how the base formation process now starts. So while discussing all the bases, we always discuss that there is a some 20-25% of up move because before any base formation. So whenever the base is forming at the bottom side, so this is how the base is formed. So whenever a V-shaped recovery comes, there is some overhead supply, the stock corrects again. And after that correction, you will always see the trading movement slows a bit in that stock, and then a base is formed. It can be a cup base, it can be a flat one, it can move sideways and consolidate. And yes, after that, there can be a good breakout if it's a quality stock, and that is the time where you should enter. So yes, two things from my this answer. One is you should be very careful with the sharp V-shaped recovery, and the second one is be very careful about the overhead supply. that can always be an issue in your investment decision. Over to you, Mayuresh.
Thanks, Vijay. Just trying to find out whether I've missed something. Too many questions.
I think Mayuresh, there are a lot of things regarding the other products about the algos, swing trading, and all those things.
Yeah, so I think so I think there have been a lot of questions about the other products as well, right? So I think if you leave behind your name and number, right, our team will get back to you on this because it's very very interesting. And I've been again at the risk of repeating myself. I think these products are brilliantly designed. They've been back tested and they work brilliantly across market conditions and market cycles. So I think if you've got specific product information, as Rushit is mentioning at this point of time, I think just leave your name and number behind or your details behind. I think our team will get back to you and ensure that your queries are addressed. There is a question that I see from Shankar Adhiman. As the crude prices start increasing, oil and gas industries most likely will have adverse impact. So there is a fundamental connotation behind this, right? So if crude starts correcting, right? So the users of crude, so the upstream companies, as we call it, will feel the brunt because their product pricing is directly dependent in terms of how crude pricing is happening at this point of time. So if crude prices come off significantly, their realizations go down. For downstream companies, which are your typical oil marketing companies, which is IOC, BPCL, I think it's a beneficial factor. But again, I think the adjustment has to happen because I think they do not keep they buy crude and they process it, right? So if they bought crude, for example, in the quarter before, and they normally keep an inventory of almost 30 to 45 odd days. So if their average basket of buying is 50, 55 and crude realizations have come to 25, 30, there is an inventory loss which gets adjusted. We've also got refining business. So the refining margins have come off significantly, right? So Singapore GRMs is a commonly used term. So I think it is a slate based on a lot of factors at play. Naphtha, ethane. So I'll not get into the fundamental details right now. But all these factors probably determine, and the crack prices determine how the gross refining margins are played out. There is a new IMO regulation which has come in from 1st April. So there are different varieties of crude that get processed. So there is a heavy light processing that happens. There is a light processing that happens. There is a sweet processing that happens. And there is this heavy light differentials which also play out. So I think that is a crux on how the overall industry works. So if crude prices come off, yes, I think the upstream companies get hit. The downstream companies sentimentally have a positive impact. But I think you should follow both aspects. So what I'm trying to tell Shankar here and for everyone as well is the price correction has been very, very brutal. Now one may very well ask that, do you purchase or pursue the dividend yield for these stocks, right? I think dividend yield is just one additional mechanism that these stocks give out. But if their cash flows are going to go down significantly, I think will these dividend yields sustain in a market environment like this? And assuming that their capex or their capital expenditure needs are still very, very prominently displayed. Secondly, I think from a chart or a technical perspective and a fundamental perspective as well, I think earnings are very, very patchy. The price volume action is clearly indicative that there is a huge overhang related to all these factors. There is no newness or the N factor that these stocks have. And the market direction is weak and the stocks react accordingly because of the overall overhang, both from a regulatory perspective, that government stake perspective, and again, I think the environment perspective that they operate out on, which gets played out on price volume action and the RSI level. So the RSIs have actually come down and have started dipping downwards. So I think we'll not try to venture or dip our feet into this. You're better off looking somewhere else, right? So I think this is something that you should also be looking at. A few of the fundamental factors and what gets thrown out in terms of chart indications, as I mentioned. Rushit, you can take the next one.
Yes, so there are a few questions related to the market direction that can be used for specific stocks. So yes, I already answered on the chat box at the starting, but let me reiterate those things that you should not use these market direction factors of follow through day, bottom formation in the stock specific that are only for indices. It's not for the stock. We want to make you clear. We have other indicators for the stock when it comes to technical, like relative strength is there. Then the fundamental side, we have EPS ranking, then accumulation distribution ranking. Or on MarketSmith India's page, you can find it as a buyer demand. It should be A, B, C, whatever it is. But yeah, it should be A plus. That are the good buyer demand. So these are the indicators you need to look for the stocks. 50 DMA, 200 DMA. But yes, this market direction is specifically for the indices. So you should not track the distribution days and the follow through day in the specific stocks. Volatility is quite high in a stock. It has a small market cap and all those things, and it is not diversified. A stock is just a company, and so when we come to index, it is a diversified thing, and cumulative movement is what William O'Neill has always tracked when it comes to the market direction. So yes, please don't use, like, this is repeatedly. I have always seen the webinars. Clients are asking about this relating market direction to the particular stock. But yeah, we have back tested. It has never worked, and this is only for indices.
Thanks, Sushil. Mr. Ratnakar Gokhale had a question. So I think I'll just repeat his question for the benefit of everyone. While you have emphasis on growth and market indicators, do you follow any ratios or numbers related to fundamentals of a company? Which fundamental value ratios do you follow? So Mr. Gokhale, I think what we are trying to get out here is, as I mentioned earlier, I think earnings is a slave in terms of how the market momentum has been, right? So I think the top line growth is one indicator, the EBITDA performance is one indicator, but we also follow ROEs. So I think the return on equity is something that we closely follow. I think as a benchmark, we've kept it at 17.5%. That is a very, very good indicator from our benchmarking perspective in terms of the fundamental aspects of the company. The second element obviously is that one may very well argue that, for example, cement companies will never reflect 17.5% ROEs. Absolutely true. So I think the other indicators are something that need to get followed at that point of time. Obviously, how the top line growth is, and the top line growth will be a function of, say, volumes and price realization, right? So if price realizations are coming off, even if volumes are going off, I think the top line growth will not get exhibited in a rightful manner. Secondly, I think in terms of input costs, since we are continuing with this example on how coking coal cost, how iron ore cost pan out, and that's a very commoditized nature of business, and it is very cyclical in nature in terms of determining that. But irrespective of that, how the companies have waded that through in terms of both their input cost, both their freight costs, which have come off significantly, the power costs, which have come off significantly for these industries, how the reported EBITDA has been and how the reported EBITDA per ton has been gets reflected in terms of bottom line and earnings performance. So ultimately, I think even if you are not able to capture the ROE for cement companies at 17.5, I think the other parameters get captured for a fundamental perspective. So at some point of time, I think we will have some capturing happening and all capturing happening for certain sectors. So financial sectors, for example, will capture all the elements in terms of earnings growth, in terms of ROEs, which is an important criteria. It's one of the fundamental criteria which we also look at from a perspective. So that's some of the indicators that we follow, Mr. What do you wish?
Yeah, Mayuresh, not many questions now, I think, related to the webinar, MSI methodology or such. There are some specific questions, but I think most of them are covered regarding the OMCs and how those things will go. And
Great.
the other product specific questions, as we already discussed, you can ask.
Yes. So great. So thank you everyone for attending this. I think it was a pleasure for conducting this webinar for all of you. One strong message, I think, follow the rules, and the second strong message, I think, you stay indoors, stay safe. What you are experiencing at this point of time is a large unknown. Don't venture out unless it's needed, and follow the Janta curfew tomorrow. I think it's better staying safe and staying healthy. I think that will also count a long way in the long run. And obviously, yes, Market Smith, Portfolio Smith are here to make tons of money for you. Yeah. So stay safe, stay healthy.